Welcome to White Coat Investor Podcast number 101, When to Hire a Financial Planner. Creighton University believes in equipping physicians for success in the exam room, the operating room, and the boardroom. If you want to sharpen your business acumen, deepen your leadership understanding, and earn your seat at the table, Creighton's Executive Healthcare MBA is for you. Specifically tailored to busy physicians, advanced clinicians, or working healthcare executives, our program blends the richness of on-campus and the flexibility of online learning. Earn a Creighton University Executive MBA in 18 months, 45 credit hours, and 4 4-day on-campus residencies. Learn in a deeply collaborative peer-to-peer cohort and elevate your expertise. Visit www.creighton.edu/CHEE to learn more. Thanks so much for what you do. Your job is not easy. I know you're probably on your way into work, maybe your way home, maybe you're listening to this as you work out or something, but hopefully you're taking some time for you. Physician burnout is a very real issue. I think most surveys are now showing about 50% or more of physicians have some elements of burnout. And that's because your job is difficult. Well, part of it's the EMR, but mostly it's that your job is difficult. It's physically and emotionally taxing. It took a lot of time to learn how to do it. It takes a lot of ongoing education. And frankly, it involves a lot of high liability. It's way easier to make a podcast. You should all take up podcasting instead. Just kidding. I'm glad you're doctors. Doctoring is hard work, and you guys deserve thanks. And I know you don't always get it from your patients. So I want to thank you today for what you do. If you are interested in meeting more of your fellow white coat investors in person, you ought to give serious consideration to coming to WCICon 20. That's going to be in March 2020. Save the dates now. It's March 12th through 14th. Registration will open in July. We'll get you the dates on that. But this is a great opportunity. We're going to have some awesome speakers and have a great time. So we're really looking forward to that. It's going to be held at the Paris and Bally's casino, conference area, etc. It's very nice. And if you don't like it, well, there's cheaper and more luxurious places to stay, both all over the place, since we'll be smack dab in the middle of the strip. But I'm looking forward to seeing a lot of you there. Also, if you haven't gotten it yet, Financial Boot Camp is out, the book. This is my second book. It really turned out great. It's getting a lot of great reviews. Thank you to those of you who are leaving me 5-star reviews on it. But please check that out. It is a 12-step guide that will take you from zero to hero in as short a time period as you are willing to check off the 48 missions in the book. But when you finish those, you will have caught up to the rest of your white coat investors and no longer feel like you're flailing around with your finances. Our quote of the day today comes from Rick Ferry, who said, "The longer an index portfolio is held, the better its performance relative to an actively managed portfolio." And that's true. By the time you're 20 or 30 years out on a portfolio, you are almost surely more likely to have higher returns with a portfolio of index funds and a portfolio of actively managed funds. Today, we've got a couple of special guests, and we're going to bring a bunch of your questions onto the podcast through the SpeakPipe. So we're looking forward to this. We're going to try to focus a little bit on the subject of when to hire a financial planner. But as usual, we're going to go all over the place with this podcast. We're looking forward to it. Okay, we have Laura on the phone here. Laura, do you want to introduce yourself a little bit? Tell us a little bit about you and your husband and kind of where you're at in your professional lives and financial lives?
Yeah, sure. So I am not a doctor. My husband's the doctor. He's currently in a hospitalist fellowship for pediatrics, and he'll be finishing next summer. And I'm staying home with our 2 kids right now. I was a teacher, but I'm taking a break for a while. And then financially, we're just trying to get set up for next year when he starts making an attending salary.
I love it. You're getting ready to hit the ground running. This is the best possible time to have a written financial plan in your life is when you come out of training next year. So you guys are doing it perfectly. There are so many people that wish they were learning this stuff, that wish they had learned this stuff at the stage you guys are at now. I meet them when they're 50 or 55 and they're like, "Where were you?" And I tell them, well,
thanks to you.
I could have really used my book too when I was in residency. So. All right. Well, let's go through some of the questions you have. You've got some old retirement accounts. It sounds like the first thing you wanted to ask about.
Yeah. So we both have old retirement accounts from former jobs. It's about $13,000 for each of us. We're wanting to roll it into a Roth IRA, but I just want to make sure this is a good idea. It seems like a good idea, but I wanted to ask what you think.
It sounds like you've got an old 403B, an old 401k, and he's got an old 401k. This is all tax deferred money, is that right?
Yeah.
Okay. So this year is the last year before you have at least part of the year of an attending salary. You're not working at all, right? So you're basically, the two of you are living on a fellow's salary.
Yeah, and we're in a low tax bracket.
Yeah. So, I mean, if there is ever a time that's great for Roth conversions, this is it, right? You're going to be able to convert all $26,000 or $27,000 you have there at a relatively low tax cost. So this is a great idea to do this year. This year is even better than next year. I tell people to do it, the year they leave residency, but that's for 401ks they're contributing to during their training. You can roll these over now because he's not currently working for this institution. This is the institution you did residency at, correct?
Mm-hmm. Yeah.
So now's a great time to do a Roth conversion. There is a downside. You do have to pay some taxes, and it's harder to come up with the tax money when you're not making a lot of money.
Yeah.
And so I think it's probably worthwhile. I'm not sure where you're going to find the money. You're going to have to cut it out of somewhere, maybe it comes out of some savings you find, or he does a little moonlighting, whatever it is. But this is a great idea to do this Roth conversion now. It'll give you a good boost to your Roth IRAs. And, I think you'll be glad you did it down the road. You'll look back and go, wow, that was the cheapest Roth conversion we ever did.
Can I ask you a question with the taxes?
Sure.
So I've read that there's a penalty if you're not withholding enough taxes during the year. Does this apply to that?
It would apply. You may still be in the safe harbor, right? There's a safe harbor. And basically you can get into that in several different ways. Given your income, you only need to pay, if you pay 100% of what you paid last year in taxes, whether you do that with quarterly estimateds or whether you do that just with withholding, that gets you into the safe bracket, the safe harbor. And so you wouldn't owe any extra penalties on that. You still have to pay any taxes you owe, but you wouldn't have to pay any penalties. Once you get to an attending kind of level of income, that's 110% of what you paid last year to be in the safe harbor. The other two ways you can get there is you can pay 90% of what you owe at some point during the year. That also gets you in the safe harbor. And the final way is you can be within $1,000 of what your tax burden is. If you can get into the safe harbor through any of those three methods, just with him withholding from his salary, then you don't have to make any quarterly estimated payments. If you cannot get into that safe harbor, then you better send him a little bit of money. But what I would be careful doing is you don't want them to withhold any money from the IRA. You don't want them to pay taxes using IRA money. Does that make sense? You want to make sure those taxes are paid with money from outside of the IRA.
Okay, from our cash flow.
So I would not have them withhold it. Does that make sense?
Yeah.
If you got to send a check into the IRS just to make sure you're okay, then maybe do that. But I'd try to do it just through withholding. Do you remember how big your tax refund was last year?
I know for this year it's should I say the number? It's 6,000.
Yeah. So that's sort of a size of a tax refund would cover this tax bill. But you're not going to get the tax refund, right? You're going to have used your tax refund to pay the taxes on this Roth conversion. Yeah. Does that make sense?
Yep.
So those are the factors you're looking at, and in the worst case scenario, you got to pay a little extra in penalty. But usually, you would be close enough anyway that penalty would be pretty minor. They're not usually terrible. So,
right.
Okay, let's move on to your next question. It sounds like a job hunting one.
Yes. So when he's looking at jobs for next year, how much do we take into account, like their pension plans and their retirement plans that they offer, as far as like financial independence and planning for the future and our nest egg and that?
Well, I mean, it's one of those things, right? Does it matter? Yes. Does it matter more than anything else? Well, no. I mean, most importantly, it's probably the people he's working with, right? I mean, you want a good fit for you, and you want people you're happy to go to work and see, So I think that's always the most important thing when choosing a job. But, there's a lot more to it. You want to look at the whole package. Is this, the call schedule going to be good? Is the the salary competitive? Is the rest of the benefits package look good? Are they going to give us, a decent healthcare plan? Those kinds of things. So you have to look at everything all together. That said, I think people are paying a lot more attention these days to their retirement plans, to what 401k or what 403b or 457 is offered. And certainly it would be a good idea to find out what you're going to have before you go there and weigh that into the balance. But I wouldn't put it at the top of my list. It's just like I had a question a couple of podcasts ago from someone who's looking at residency and wondering how much they should be weighing their benefits package. And residency, it's almost nothing, because the packages are so similar. As an attending, I don't think it's nothing, but it certainly isn't, a primary consideration. The other thing to keep in mind too is retirement plans change. I'm on about my third retirement plan in a partnership I've been in for 8 years. And so they change. So you don't want to, base all your decision on just the retirement plan. The good news is they usually change for the better. Plans are generally getting better over time. Employers are realizing they have a fiduciary responsibility to their employees and that they can be sued if they're putting together a crummy 401k. And so I think the general trend is that they're getting better. So I wouldn't spend a lot of time worrying about that, but certainly find out what you're getting into as part of the interview process.
Okay.
So you had some questions about pay and public service loan forgiveness and how all this kind of comes together, which I think we may have to revisit your first question about the Roth conversion as we talk about this as well. It sounds like you're thinking about public service loan forgiveness. You're set on public service loan forgiveness. What really is the plan there?
We're pretty set in it. So he'll be paying for 5 years out of when he's finished with his fellowship. He's doing the pay program.
Okay. So how many years of payments has he made?
He's in, 3.5 now.
3.5 years of payments. Okay.
Yeah.
And it'll be another year anyway, another year and a half.
Yeah. So he should have 5 years of payments when he's starting his attending.
And about how much is the loan burden?
Actually, our first year it was nothing. Right now the loan burden is $300,000.
$300,000. So a pretty significant amount in comparison to a pediatric hospitalist's salary.
Yeah. Yeah.
So I can see why you're very interested in public service loan forgiveness. So here's the deal. The key to getting the most forgiven is paying the least as you go along. The less you pay, the more you have to be forgiven. Mm-hmm. And so you tend to do everything you can to make the payments as little as you can. And so one of the things you do for that, if you're both earning, which doesn't apply in your situation, but if you're both earning, sometimes you even do married filing separately when you file your taxes to get the lowest possible payments for your pay program. In your situation, I don't think that's necessary at all. You guys can certainly file married filing jointly, and that'll probably result in the lowest possible tax burden. In fact, I suspect you may be in the wrong payment plan. Pay as you earn is probably not the right payment plan for you guys. You probably want to be in revised pay as you earn.
Okay.
And the reason why is that you get the interest rate subsidized a little bit. Will it matter a lot if you're going for public service loan forgiveness? Not really. But in the event that something changes and you end up deciding to pay him off, the program goes away or his career plans change or whatever, then you'll be really glad that you minimized how big that loan got. Is all $300,000 of the loan going to be eligible for public service loan forgiveness, or is some of it private?
It should be.
It's all federal direct loans.
Mm-hmm.
Okay.
And so my question is, can we switch to repay at this point?
You can, and all the payments count. The old payments still count. A lot of times when you switch program, I think it's required that you make one full payment between them. So it may not be worth it to you guys to switch if you're really committed to public service loan forgiveness. But it would be, you would have a lower amount of debt. Does that matter since the rest is forgiven tax-free? Not really. But it would result in less debt overall that was left there to be forgiven. The other thing that you can do to reduce those payments is to keep your taxable income down, right? Not moonlighting results in more forgiveness. Not making a lot of money as an attending results in more forgiveness. Not doing Roth conversions results in more forgiveness. Doing tax-deferred retirement plans results in more tax forgiveness. So in your case, the general rule as a resident is, do Roth contributions, do Roth conversions. In your case, where you're pretty set on public service loan forgiveness, you may come out ahead financially actually not doing that stuff and doing tax-deferred payments to keep that payment as low as you possibly can. And that is something you just have to run the numbers on. I generally recommend people in those sorts of situations actually hire professional help. I've got a list of people that give student loan advice on the website under the recommended tab, and they'll usually charge you a few $100s. But they'll go through your taxes with you and how you should file them, and whether you should be using Roth accounts or tax-deferred accounts for any retirement savings you're doing, and figure out the best program for you to be in, etc. And truthfully, when you're looking at maybe getting $300,000 forgiven, it's probably worth paying $400 or $500 to somebody to have them really go through those numbers with you with a fine-tooth comb and making sure you're doing it in the way that it's going to work out the best. I wish I could do that just on the podcast, but you literally just got to run a bunch of calculations.
No, we'll definitely check it out.
So,
thank you.
That's probably worth doing for you guys, and maybe even before you do those Roth conversions. So I would get this sorted out this year so you can make a decision about those Roth conversions or not.
Oh, all right.
Okay, let's move on to your next question, which is a really good question that I actually titled this podcast after, about hiring a financial planner and how you know when you need to do it. What thought have you guys given to this in the past? Have you had any sort of financial planner or financial advisor in the past, or you just starting to kind of feel like maybe you need something, or what?
We've had like a few of the sham type people approach us.
The sham
but
type
now
people?
That we're the fake financial advisors. But now that we're looking to start earning more money. Part of me thinks, we can just do this. We can put away our savings. We can manage our money. And part of me is nervous to make a mistake like what you were just explaining about the repay versus pay. And it's an expensive thing when you're on a fellow salary. So at what point do we need to start paying somebody a lot of money?
Certainly this isn't a bad time to get some financial advice. Certainly about those student loans. I think that's worthwhile. The thing you mainly need is you need a written financial plan in place. And if you feel capable of writing that financial plan, I don't feel like you have to hire anybody. If you do not feel capable of writing that financial plan and being confident that, okay, this is a good plan, then I think you need to do something. And you've basically got three choices. The first one is to start reading a bunch of books and blogs and participating on internet forums until you kind of have this stuff down. And you can do that both asking and answering questions. You'll learn a lot. This is basically what I did. I was kind of a do-it-yourselfer, and I learned all this stuff eventually. The second option you have is something like my Fire Your Financial Advisor online course. The whole point of that course is for you to come out of it with a written financial plan that you wrote yourself. And so that's the whole point of it. It's not as cheap as reading books and blogs and participating on forums. We charge $4.99 for the course, but it's dramatically cheaper than paying a financial advisor. And so that's the right choice for some people. For other people, the right choice is to hire an advisor. And the key there is to get good advice at a fair price. But there are lots of financial advisors. I keep a whole list of them on my website under recommended financial advisors or best financial advisors that will help you put a financial plan in place. Even if you don't want their help in implementing it, even if you don't want to pay them every year, an asset under management fee to keep the plan going, they will help you draft up a financial plan. Now, that's probably going to cost you some money. The more you can do yourself that you bring to them, the less it'll cost you. But it's going to cost you at least paying for a couple of hours of their time at $200 or $300 or $400 an hour. And more likely, it's probably going to cost you something like $2,000 or $3,000 or $4,000. That's just what it costs to go to a professional and get a financial plan drawn up. So I think those are your three options. Obviously increasing expense, but you get increasing help with each additional step. So when should you do it? I think it's worth doing anytime you're making money and don't have a written financial plan. If you need the advisor, go hire the advisor. You don't want to be penny wise and pound foolish. But you do want to pay attention to the fees and not pay fees that you don't need to pay. So it's kind of a balancing act there. Does that make sense?
It does. Thank you.
So it sounds like you and your husband are doing some good for the next generation of docs coming up. Tell me about these kind of teaching things your husband's been doing with the residents.
Oh, it's nothing amazing. He just it's amazing to see the residents that come out and they'll have no idea, what what's being withheld from their paycheck or how to set up a 401k. So just, just even helping friends get their 401k set up and stuff. And we're just all at the very, very beginning of learning how much the government is getting paid and how much we should be saving. So,
it's amazing though how much good you can do. The first few things you learn about finance are so high yield, that you can really make a big difference in somebody's lives. I think that's especially true with docs that have come from another country. They don't even know our tax system. They don't 401k. What does that mean?
And all the SS and all the
right. So
weird
it's just
acronyms in there.
Totally foreign language, and to help people walk through that is really a wonderful thing to do. So thank you to both of you for the assistance you're rendering to your peers and trainees. That's really wonderful. So thank you so much, and I appreciate you coming on the podcast today.
Yeah, thank you so much.
So thankful to have had Laura on. That was great. I love having your voices on the podcast. I think it's much more interesting for you guys listening out there to be able to listen to something besides my voice droning on all the time. Her question about when you need an advisor is kind of the opposite question I tried to answer with a blog post back in January, which was, how do you know you're competent to be a do-it-yourself investor? And the points I tried to make in that post are pretty relevant to this discussion. I mean, the first one was that you don't have to be fanatical about it, right? You can have a combination of using an advisor and doing some stuff yourself. It's not like you got to go all or none. And in fact, you can even use an advisor for years and then switch to being a do-it-yourself advisor, or use an advisor on one account and do it yourself on another account. There's a lot of different combinations. But I think there's a few things you have to have in order to be a do-it-yourself investor. You've got to be interested in it. If you're not interested, you're not going to gain the knowledge you need to do it well. You're not going to gain the discipline you need to do it well. So the first thing is you got to be interested. And I think when you can write your own financial plan and go, yeah, that's a pretty good financial plan, then you probably don't need a financial advisor, right? If you look at it and you go, I don't even know where to start writing a financial plan, then you probably ought to go hire somebody, or take my online course, or at least start reading some books. I think another time when you realize that maybe you're ready to start doing it yourself is when the fees are really bothering you. When you're like, man, I paid $5,000 or $10,000 or $25,000 last year in advisory fees. I really don't want to do that. I don't feel like I'm getting that much value out of this. Then it's time to start learning some more and becoming a do-it-yourself investor. When you're listening to advice from your advisor or from radio hosts or on this podcast and you're starting to poke holes in it, when you're going, well, that's not right in this situation, when you can actually defend one side of some of these common controversies in investing, like what a safe withdrawal rate is, or whether you should use a Roth or a traditional 401k, these kinds of questions, when you can actually have these debates and defend both sides, you probably know enough to start managing your own money. You probably need to have read some books too. Honestly, it's possible to learn all this stuff on the internet, from blogs and forums, but most people find it's much more of a shortcut if they read at least a few good financial books. Another important task for a do-it-yourself investor is knowing how to ask and answer your own questions. If you know where to go to get the answers, then that's worth a lot. If you go to irs.gov for some things, you go to a good forum like Bogleheads or the White Coat Investor Forum or the Fairmark Forum for tax issues to get other things answered. When you know how to go get the right answers, then I think you're much more competent to be able to be your own financial advisor. And particularly as you start finding yourself teaching, when you're teaching other people about this stuff and you realize, wow, maybe I know more than I think, then that's the time when you can start saying, well, maybe I'm ready to start being my own financial advisor and do this myself. I think it's important to have sufficient confidence, but not be overconfident as well. If you, think you can predict where interest rates are going or where the market is going, you're probably overconfident. But I think as a general rule for most docs who are learning this stuff and progressing toward becoming do-it-yourself investors, your confidence generally lags your knowledge level and your skill level by about a year. A lot of people look back and go, I could have been doing this for the last year, but they just didn't quite have the confidence to do it. So as you learn this stuff, realize this is something you can do. It's not that hard to do. If you're willing to put the time in and you're willing to develop a little bit of discipline to stay the course through the down markets, then certainly you can save the thousands of dollars a year it will cost you to get good financial advice. All right, so let's move into some of your questions. Our first question here comes from James about salary transparency.
Hi, Dr. Dolly. This is James from sunny San Diego. I have a question about your thoughts on salary transparency in general and in the family. Should doctors know or be able to find the salaries of their fellow doctors in the group, hospital, or academic institution where they work? What about doctors who are seriously considering a career move into a group, hospital, or academic institution? Could you comment on the current state of affairs around salary transparency in medicine and state if you think things should change? Finally, should kids know how much their doctor parents make? Also, do you think that parents should know how much their kids make when they have left home and are young professionals?
He's basically asking a bunch of different things. Should doctors be able to know what their peers and potential peers make? And if not, should that change? Also, should kids know how much their parents make? And should parents know how much their kids make when they leave home? Well, there's a lot of it depends involved in this question. Salary transparency is a big, almost a political topic these days. A lot of people are big fans of it. It was interesting. I listened to a podcast on Planet Money, a couple of years ago about a company that decided to be radically transparent about what everybody was paid in the company. And they just put a spreadsheet up on the company website, on their intranet, with everybody's salary on it. And you could look it up at any time. And it was interesting. Some good did come out of it. And a lot of frank discussions came out of it where employees were told, you're not worth that much to our company. That's why we're not paying you as much as Sally down the hall. And there were a lot of kind of hard feelings that came out of it as well. So I don't think it's all unicorns and rainbows, and sprinkle cupcakes to have salary transparency. That said, there are certainly some benefits there. When it comes to negotiating, information is power. The more you know about what other people in that company are being paid, the better negotiating position you are in. So salary transparency helps the workers and hurts the owners, in that negotiating position. There's a lot of good data showing that companies where the salaries are more transparent have a much smaller gap between what men are paid and what women are paid to do the same job. So this has become a big issue among advocates for equal pay between the genders. And so that's certainly one issue of it. I think there's just a little more of a systematic approach to salaries that people take when they're transparent. Most of us had transparent salaries when we were in residency, right? Everyone got paid the same, no matter who they were or what they knew. We were all paid the same as a PGY2. In fact, usually across the hospital, you're paid the same whether you're an orthopedist or a pediatric PGY2. Certainly the military's that way. A lot of partnerships are set up that way. They're eat what you kill, and so I think it's possible to be very transparent in a lot of jobs, but it's not all perfect to have salary transparency. There are some issues with it, and there really can be some hurt feelings over it if you're not careful about how it's done. Now, as far as this question about what kids should know about their parents, I think you've got to approach the kid. Every kid is individual. I don't know that any of my kids know exactly what we earned last year. It doesn't help that our income is so variable month to month and year to year. But they know that we're well off and that we make plenty of money. And so we don't hide that from them. I think it would be impossible to hide it from them, honestly. But we don't sit down and do our taxes with them. Now, if they came to me and sat down and wanted to talk about it, I think if they were old enough that I wouldn't have to worry about them running around the neighborhood telling all the neighborhood kids what I made, I would probably sit down and have that discussion with them. But my 9-year-old running around the house asking me what I make, he's probably not getting the straight answer either. So I think there comes a time and place to have that sort of a discussion with the kids. As far as whether parents should know what their kids make, I don't think so. Do you go tell your parents what you make? I don't think that's really something that needs to be out there. Is it bad to have frank discussions? I think it's perfectly appropriate in some families, but I think in other families it can cause a lot of problems. I know particularly in some cultures there's a heavy expectation for the kids, especially the financially successful doctor-type kids, to be contributing to the parents and even to their siblings. And so I think that can get a lot of people in trouble when you're radically transparent among family members about those salaries. So be careful with that. All right, our next question comes from an anonymous pulmonologist.
I'm a pulmonary critical care physician. started my job after fellowship since last 3 years. I have been late to the world of investing, but I got subscription of Motley Fool Stock Advisor Service, which recommends 4 stocks every month, and I have been following with them for about 18 months now. I have been almost following every recommendation and have been buying stocks as per their recommendations. Unfortunately, now my stock portfolio has become almost more than 110 different kinds of stocks, and I think it's getting too much for me to keep a handle on. So I would like to simplify, and I want to know how to do that. Uh, I think going index funds might be easier, but I'm not sure how to decide which stocks should I sell, which should I retain, and if you can guide how to simplify things. Thank you.
So basically, this doc has been picking stocks using a newsletter. For better or for worse, that's what the Motley Fool, stock recommendation service is. It's a newsletter. They send it out saying, buy this, buy that. And this is a good example of what happens when you actually follow the instructions of those things. Now this doc is 110 stocks. I mean, nobody can follow 110 stocks. It's impossible to keep track of all that. That's a ridiculous portfolio. Not only is it ridiculous, he's running a fair amount of uncompensated risk. And now just to get out of this portfolio and get into a set of index funds, he's got to probably pay all these commissions at $7 or $8 a piece to sell these stocks. So this is not the kind of portfolio I recommend. I think he gets that he would be better off in a handful of diversified index funds. But the question is, how do you do that? Well, the way you do it in this sort of scenario, it doesn't sound like he's been doing it all that long. And so there's probably not that many capital gains there. But in a taxable account, you do want to be conscious of how much you're going to have to pay in capital gains taxes. If your basis is very low compared to the value of these stocks, you may want to think twice about selling them. You may want to build the portfolio around some or all of these stocks. Certainly, you can sell the losers. You can sell the ones where the basis is about what the value is, and hopefully be able to get out of most of them without having to pay too much in taxes. But in this sort of a scenario, I just wouldn't want to be interested in following 110 stocks. So I'd be selling them like crazy. I'd probably have them all sold within the next 2 or 3 days and just put the money into an index fund. Certainly, if you're in a Roth IRA or a 401k where there's no tax cost and maybe not even a commission cost to selling these things, then I'd do that right away. Obviously, there's no tax issue there. But in a taxable account, there's going to be some tax complications and consequences of that mistake of basically trying to be a stock picker based on what a newsletter is sending out. What's interesting is that he's probably not even tracking his return on these assets. He may be underperforming an index fund, he may be overperforming the index fund, but who can keep track of it when you got that many pieces coming and going and that many moving parts in the process? Our next question comes from Matt.
My name is Matt, and I recently became an attending physician and had the opportunity to do a backdoor Roth IRA in 2018, which I did for myself and my wife. We invest through Fidelity, and so that required a 5-day wait for the accounts to settle before I could actually do the conversion from the traditional IRA to my Roth IRA. But everything ultimately went smoothly. But now that it's tax time, I looked at my account, and lo and behold, I actually gained some interest in my traditional IRA while the accounts were settling. So I actually have 37 cents in my traditional IRA account. And so my question is, what do I do with that? Is that going to trigger any kind of pro rata calculation or kind of mess things up? Or is it just insignificant and basically contribute the max amount minus 37 cents to my traditional IRA in 2019 and then do another backdoor Roth for this year? I'd love to hear your thoughts. Thanks.
This is such a common question. I wrote a blog post about it. It's called Pennies and the Backdoor Roth IRA. He's basically asking, what does he do with the 37 cents left in the traditional IRA account after doing the Backdoor Roth IRA process? And pretty much all of us have this happen to us every year because you earn a little bit of interest in the 1 or 2 days that the money was in the traditional IRA before you move it to the Roth IRA. So what I usually do is I just convert that 37 cents to a Roth IRA. Technically, it's taxable, right? But since you round everything down to the nearest dollar, there's actually no tax cost. You just got a free 37-cent Roth conversion. So that's great. But even if it was $5 or $10 or $250, that's still what I would do. I would remove it out of the traditional IRA and into the Roth IRA and just pay whatever taxes are due on it. If it's truly just a few pennies, you can leave it in the traditional IRA and roll it over next year when you put in your next contribution for next year and just not worry about it. But what I would do most of the time is just go back in there and roll those few dollars or few cents into the Roth IRA as well. Okay, our next question comes from Wasim.
Hi, Dr. Dolly. My name is Wasim. I'm a single 27-year-old guy in my third year of radiology residency in a high-cost living area, which means I have 2 more years before graduating if I include fellowship. I plan on moving back to the Midwest in my hometown, which is a much lower cost living area. Currently, I'm maxing out my 403b, saving approximately 30% of my income each month for my investments, and I'm lucky to have no debt. I have a question about my investments. I currently only invest in the Vanguard Life Strategy Moderate Growth Fund, which has a 60-40 stock to bond ratio. I think I'm playing it too cautiously and now want to invest a bit more aggressively, but still keeping it as passive as possible. I was thinking of buying separate index funds for the total stock market, total international stock market, and a REIT. Do you think I should be investing in bonds at all for someone in my stage of life? If so, how much? Thank you for everything that you do.
So Wasim is a resident in a relatively conservative portfolio for a resident. I mean, it's basically 60-40. 40% bonds is a lot of bonds for a resident. I mean, this is a relatively tiny portfolio compared to what he's eventually going to retire with. And so it certainly wouldn't be crazy to have a more aggressive portfolio. 75% stocks, which is the maximum that Benjamin Graham, Warren Buffett's teacher, recommended you ever have. Even 90% stocks or 100% stocks would not be crazy in this sort of a scenario. So do you need stocks in a 4-figure portfolio you have as a resident? I mean, do you need bonds? Well, probably not. Does it really make a difference? No, but it's a good chance for you to see how bonds perform, how stocks perform as you're beginning to be an investor. And so I think there's some value there in having some bonds even from the beginning. But let's not kid ourselves. What really matters when you're investing early on is how much money you're putting in the account, not so much what the asset allocation is. So I would concentrate on income, I would concentrate on savings rate, and I would worry a little bit less about asset allocation. In fact, I would probably, if I had it all to do over again, I would probably just leave my money in a target retirement or a life strategy fund of funds until I had $100,000. It just doesn't matter that much early on. If you want to break it down and play with your money a little bit more, that's okay. You might be able to save a little bit of money in expense ratios, maybe fine-tune your asset allocation a little bit better. But really, this doesn't matter that much when you're a resident. What really matters is hitting the ground running when you become an attending. Okay, our next question comes from Will.
Hi, Dr. Dolly. Thanks as always for all the hard work with the blog and the podcast and the book. I wanted to ask you about your thoughts on helping parents in retirement. So I'll be an anesthesiologist in the summer. I'll have way more money than I could ever need. And my parents have always been incredibly supportive of me, but unfortunately they have not saved much of anything from the rather large income they have had. Is there anything in general that's really good when you want to support your parents or help them retire? I was thinking about either just giving them money every year or maybe paying for the mortgage or, buying VTSAX in their name or just paying for flights to come visit. I'd really love your advice. Thank you.
He's basically asking, what should I do to support my parents who never saved despite a high income? And this is a question I think a lot of docs struggle with. I'm lucky enough that my parents have done very well. They were very frugal, And after my dad retired with a pension, he actually kept working and built up a pretty sizable nest egg as well. So this is not something I really have to worry about. But what do you do for your parents? Well, this is, again, very individual. I think you need to be careful. It's the same problem you have with supporting children. If people are getting support that they don't have to work for, maybe they don't always make the best financial decisions. Maybe you're enabling their bad decisions. And so you got to be careful to walk the line between enabling and just being a jerk and not helping. And so I think it's a difficult conversation. I think the conversation is best had with the actual blood relative. This isn't something you should do with your father-in-law and mother-in-law. This is a conversation that their child should be the one who has it with them, and probably in conjunction with their other siblings, to decide how much are we going to help our parents, how much are we going to support them. Certainly you don't want to just be throwing money down a rat hole. If they've got a meth addiction or something, you don't want to be supporting that. Likewise, terrible financial decisions, you don't want to be supporting those. But you probably want to keep a roof over their head and want to keep food on the table, etc. Certainly, it's reasonable to do little things on the side that make a difference, like, they may not come see you and their grandkids if you don't buy their plane tickets. So that seems like a reasonable thing to do. But I probably would not make a habit of, making their credit card payments for them. I would probably demand that they chop up the credit cards before I actually assisted them financially. I think it's okay to set limits. When it's your money that we're talking about, it's okay for you to set some of the rules. But that's got to be done very, very politically and with a great deal of compassion, I think. Okay, our next, last two questions here, both from the same asker. Karina, let's listen to her first question.
I'm on my second year as an attending in a low-earning specialty in an academic hospital. This year, my husband and my adjusted gross income went above the $199,000 contribution limit of a Roth IRA. However, I still contributed $5,500 to my Roth IRA. I know now that this is not allowed, and I am going to take the money I contributed out and instead do a backdoor Roth IRA like I had learned from you. But what should I do with the money that was earned from those $5,500? Should I take it out or leave it in the Roth IRA? Will it be taxed like ordinary income? Will there be any penalties for taking that money out?
Okay, basically what she's asking here is, what should I do with the earnings in the Roth IRA that I shouldn't have contributed to in the first place? Well, what you do here in this situation is actually pretty common, just from people who don't know about the Roth IRA rules, is you recharacterize the Roth IRA contribution to a traditional IRA contribution. And when you do that, both the principal and the earnings go into the traditional IRA. Then you have to wait a certain period of time. There's IRS rules on it. It depends on what time of year you do it, actually, how long you got to wait. And then you convert it all back to a Roth IRA. Now, at that point, you're going to owe taxes on the earnings portion of that money, just because that part hasn't been taxed yet, unlike the traditional IRA contribution that was after-tax money. But that's the way you do it. You recharacterize it to traditional IRA, you wait a few months, and then you convert it to a Roth IRA and pay any taxes due. Pulling the money out of the account probably isn't a good idea. That often triggers penalties and keeps you from being able to keep all that money in the account like you wanted to in the first place. Let's listen to her second question.
I am originally from a small country in Central America, but was born a U.S. citizen as well. I came to the U.S. for residency and stayed for fellowship and met my husband. I am now in my second year as an attending in a low-earning specialty in an academic hospital. Because I did med school in my home country, I have no student debt. We own our cars and only have a mortgage for a $200,000 house. My husband and I are hoping to retire early in the next 10 to 15 years. After retiring, we are hoping to spend a significant amount of time traveling and living outside of the U.S., most likely in Central America. Are there any types of specific investments you would recommend in this scenario that perhaps would give us a break at the time of taking money out to live outside of the U.S.? I know we can transfer money outside of the U.S., but that comes with extra fees, which we would like to avoid. Thank you.
Now, this is a much more difficult question. I had to actually do a little bit of research about. Most of the time, Let's be honest, when people are asking me questions, it's the same 30 questions over and over again. But this one, I actually had to do some research. Basically, if you're planning to retire in 10 or 15 years outside the United States, are there specific investments or specific financial things that you should do now? Well, the main thing is if you're going to want to retire in 10 or 15 years, you've got to save a lot of money. Even if you're going to be living in a lower cost of living country, you got to save a lot of money, and you probably have to be pretty aggressive with your investments because you need your money to do some of the heavy lifting. Bear in mind, you can use retirement accounts, but you are going to pay U.S. taxes on the money when it comes out of those retirement accounts. That's just the way it is. If you got a bunch of money in U.S. retirement accounts, you're going to pay U.S. taxes on that money when it comes out. But since you'll likely need a lot less money to live in Central America or someplace like that, you may want to maximize the use of tax-deferred accounts rather than Roth accounts, because you'll be in a lower tax bracket. You'll have a lot less income when you're living in retirement. You also need a plan to get to that money before age 59 and a half. This is an issue that every early retiree's got to work around a little bit. The easiest way to do it is with what's called the SEP rule, Substantially Equal Periodic Payments rule. And you basically take out the same amount from the time you start taking the withdrawals until you hit age 59 and a half. And that allows you to get to your retirement money without having to pay the penalty. So basically what they're saying is early retirement is an exception to the age 59 and a half rule. You should also be aware of state taxes. Okay, if you are going to live in another country, it would be ideal if the state which you're having to pay U.S. taxes on is a tax-free state, like a Nevada or Alaska or Washington or Florida, Texas, etc. That would certainly reduce your tax burden. You may find it's easier to buy ETFs too when you're overseas, just because brokerages are much more likely to be used to dealing with the compliance rules from foreign countries' taxes than a typical mutual fund provider might be. So that may be worthwhile looking into as well. If you do decide to maintain your U.S. citizenship, you're going to have reporting duties to the U.S. You have to report bank accounts over $10,000. You have to report property over $50,000. You still have to actually pay U.S. tax on any foreign income that you receive. So that leaves you with the question, do I renounce my citizenship? And that's expensive too. Here's what happens when you renounce your U.S. citizenship. First, you pay a fee of $2,350. Yeah, just to walk out the door, that's what it costs. But you're trying to avoid being what they call a covered expatriate. And one of the ways you can get that is having a net worth of $2 million or having a tax burden, actual tax liability of $160,000 or more for the last 5 years. If you become a covered expatriate, you'll actually owe taxes as of the day you renounce your citizenship. Now, they give you a $700,000 exemption on capital gains, but any capital gains above that, you'll have to pay capital gains taxes. And you could also owe state or federal estate taxes, depending on the size of your estate. And so you really have to calculate carefully and actually time your exit from the country when you renounce your citizenship, if that's something you're going to be doing. So this is going to require some planning ahead if you really want to leave the U.S. and not be a U.S. citizen. If you're going to continue to be a U.S. citizen, well, just continue to, plan to continue to pay U.S. taxes, because you're basically going to continue to pay taxes just as though you were continuing to live here. I hope that's helpful and answers your question. Great question, Katrina. This episode was sponsored by Creighton University's MBA program. Creighton University believes in equipping physicians for success in the exam room, the operating room, and the boardroom. If you want to sharpen your business acumen, deepen your leadership understanding, and earn your seat at the table, Creighton's Executive Healthcare MBA is for you. Specifically tailored to busy physicians, advanced clinicians, or working healthcare executives, our program blends the richness of on-campus and the flexibility of online learning. Earn a Creighton University Executive MBA in 18 months, 45 credit hours, and just 4 4-day on-campus residencies. Learn in a deeply collaborative peer-to-peer cohort and elevate your expertise. Visit www.creighton.edu/CHEE to learn more. Be sure you check out the White Coat Investor Financial Bootcamp book. It's out. It's great. It's getting some great reviews. You can pick that up at Amazon today. Also, an e-version and an audiobook is available. Thanks for subscribing to the podcast. Thank you for giving us a 5-star review on iTunes. That does help spread the word of this message to your peers. Head up, shoulders back. You've got this. We can help.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.